Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. If you are new here, this channel is all about building long-term wealth the halal way. I invest for future cash flow, dividends, rental income and businesses with strong moat. Today's video we are looking at 5 companies that I believe are temporarily undervalued, offering potential long-term opportunities inshallah. We do this every single month. At the beginning of the month, we look at 5 companies that could potentially be a good buys for your portfolios. Again, I'm not a financial advisor, but all I'm doing here is just sharing with you guys the facts, the information about these companies, and then of course it's your your responsibility, if you like, to go away and do a little bit more digging about each one of the companies we're going to talk about today. So I will give you an overview about each one of the companies. I'll tell you why they are undervalued at this point in time, and we'll take it from there inshallah. But before we do that, I just want to check a couple of things. And the first thing we're going to look at is the Fear and Greed Index. This index sort of tells us what investors are thinking about right now. What is their sort of feeling about, if you like, about the market right now. And a lot of the markets right now are basically feeling extreme fear, and that is an opportunity. When this happens, basically the market is in the red quite a bit. People are not really thinking about buying stocks, and everyone is just sort of selling, if you like. And this is where genuinely I buy more stocks, because if everyone's selling some of the best and high quality companies out there, then of course it gives us an opportunity, and that's exactly what we're going to look at today. You'll see there's some really good companies in this on this list that are not right now basically currently undervalued. If we look at the S&P 500 right now, so just for the 1 month since basically October, you can see the S&P 500 is down, just a flat almost. The Dow Jones is flat as well. It's about 1%. Nasdaq is down, which is interesting. And the FTSE 100 is the only one that's up 1.4%, which is really good. I keep saying that the FTSE is doing really well, but I need to look at, inshallah, I might start looking at some basically companies to invest within the in the UK inshallah in the next few days. But yeah, these are the 3 main indices, US indices, and they all are undervalued basically right now, down for this month, for the 1 month. But when you look at things like for the last 6 months, then of course it changes completely. Or even if you look at the year to date, we're looking about 14%, 10%, 19%, 17% for the S&P 500. Again, the S&P 500 the FTSE 100 outperforming the rest of them, apart from the Nasdaq, which is quite interesting. So this time last month, we looked at 5 companies. We looked at S&P Global, Qualcomm, MSCI, Corpay, and ServiceNow. And as you can see, this is where they are. So for the 1 month, so just the scenes that we recorded that video, the companies, these 3 have done okay, better than the S&P 500, because you've just seen everything else was done apart from the FTSE 100. And these 2 here, probably because they've reported their earnings have not been great, that's probably why they're down a lot. But the rest of them have done okay. Especially Qualcomm, I think since then has gone up a lot because of and then it came back down again because they now have they're getting into sort of that market with Nvidia and AMDs and so on. So just to be transparent, these are the 5 companies we looked at the last month. Now let's have a look at the companies we need to talk about today. And as always, we're looking at the same sort of information, and the first company we're going to look at today is Intuit. You might be surprised to see this one, but right now it's undervalued by 11% according to Morningstar valuation. Intuit is the company behind QuickBooks, TurboTax, Credit Karma, tools used by millions of individuals and small businesses worldwide. And what makes it so attractive is basically that recurring revenue model that I really like. And if you've seen me talk about businesses, especially software businesses, I like that recurring revenue side of things. Okay, financially, this is basically a great machine. They've done really well. They currently have 180 billion market cap. They have a white moat. Price right now $648 per share. Small dividend, but they are growing that dividend every single year. It's safe 94%. profit margin 20%, return on equity of 20%, return on invested capital 14%, free cash flow right now we've got over $6 billion, and the EPS is expected to grow about 13%, revenue about 12%. Morningstar valuation is saying is about 11% upside from where we are. $720 per share is where they think the price should be. Now if we look at it straight away, if we go to seek fast graph for example and look at sort of historically where this company has been, that orange line is basically that sort of a tracking that 15 PE sort of earnings if you like, operating and earnings if you like, and then we've got the price. The price has always been up and down, and this blue line is basically what the market likes to trade that company. And as you can see, it is quite close to where the company has been trading, so that 29 almost a 30 PE if you like. Now if we look at the performance for this company, okay, over the last whatever years, so since 2005 against the S&P 500, this has returned compound basically a growth rate of about basically 18%. The S&P 500 just about 9%, so it's beating the S&P 500 in terms of dividend growth side of things is also beaten. So right now if we look at the forecast moving forward, if we use the estimates, which is that 13 growth expected to grow about 30, the EPS growth if you like, and then again another 13 there. Basically right now of course you'll be losing a bit of money, but if you use the normal multiple, which is this company has been trading over the last whatever years, which is that 38 if you like, if you bought the stock right now, you will basically make 80% of your money, which is quite interesting. So your 10,000 will become 18,000 US dollars. So again, another one to consider if you are interested. Again, do a little bit more research to make sure that you understand how the business works and what they do. And again, of course, don't take my word for it, please, because I could be wrong. The next one is one of my favorite dividend growth companies. They provide payroll, HR, workforce management services, meaning basically they have a recurring cash flow and high customer retention as well. This has 102 billion market cap, another white moat, $254 per share right now. That dividend is really good. 2.4% is been the highest that I've seen in the last few years. Payout ratio right now just over 61%. I don't like that. Hopefully they will bring that down. The latest increase 10%. The 5-year growth rate is basically about 11%. 51 years of increase in that dividend. So they are a dividend king already. Annually, you get $6.16 payout rate, so dividend safety of 97%. So very, very, very safe. Profit margin about 20%, return on equity 70%, return on invested capital of 38%, almost 39%. Free cash flow $4 billion. EPS expected to grow 9% next year. Revenue about 6%, 20% upside from where we are. $305 per share is where they think the price should be. And looking at the fast graph, as you can see, more or less similar sort of a story. Another company that's been overvalued for a very long time. That blue line way ahead of that orange line. But when you look at that dividend growth for whatever years, look at that. It's expected to also grow in the next few years. If we look at the performance over the last whatever years, so since 2005 up until now, it's beating the S&P 500, which is quite nice to see with that growth in terms of dividend side of things. So this is a very high quality business. Now, if we're using the estimates of that, 9% and 9% side of things, again, you will be losing a bit of money. But if you use the normal multiple, which is basically that 28 PE or on average for the last 5 years, and you bought the stock right now, you will be making your 10,000 will give you about 15,300 by the time we get to 2028. The next one that we're looking at is today's deck is Outdoor Corporation, and this is the company that makes Hoka, the basically trainers and so on. They've got excellent brand names. They've been undervalued for quite some time now. It's a small company, about 12 billion market cap. It has a narrow moat, $81 per share right now. Profit margin, we're looking at about 19%. Return on equity, 43%. Return on invested capital of 37%. So very well run business. They also have a small free cash flow, but just 11 billion market cap. So that's not bad at all for free cash flow under 880 million. EPS expected to grow about 1% in 2026, I think, and revenue is about 8%. Morningstar is saying it's almost a 50% undervalued at this point in time. It has a 50% upside from where we are. $122 $22 per share is where they think the price should be. If we look at faster graph, as you can see, this company has been trading within, this is what you want to see, that blue line, that orange line, almost with the price line all together. Literally, if I remove this now, you can see the blue line and the orange line being together for all this time. It's never been above that. So most market is not trading this company very expensively. And then when you look at the price, dear Lord, look at that. They basically, the PE over the last, especially when was this, 2025, January 2025, the company was selling for $209 per share. And if you had the stock around that time, you would have lost, your 10,000 would have become 3,800 US dollars, which is absolutely ridiculous. Now, if we look at the performance over the last whatever years, so we're looking at since 2004 and up until now, they don't pay any dividends. You would have made about 17-18% against the S&P 500 of that 9%. So you have beaten the S&P 500. If we look at the forecast moving forward for this company, okay, if you use the estimates, normal estimates right now, that is basically about that, forward EPS of about 7%, 12%. If you bought this stock right now, you cannot go wrong. That 10,000 will become 14,000 US dollars by the time we get to 2028. If you use the normal multiple, which is again that 20 PE, you will slightly make a little bit more. So you're almost doubling your money. 19,200 is what you would have by the time we get to March, to the 31st of March 2028. So another great company that seems very much undervalued at this point in time. Please do you research this. A lot of things affecting this company's performance, and a lot of that is probably something to do with the tariffs and what's been happening in the US with, Donald Trump 1 minute basically fighting with this country, with that country. That has affected the company. So let's see, what happens moving forward. But for now, I think it's one of those companies that you just nibble it, just buy as much as you can here and there, and then of course continue. I know a lot of the brothers on the Discord. By the way, the Discord is free, and you can just join it now. It's the link on the description. If you haven't liked the video, please do so. If you haven't joined us at the Patreon account, please do so as well. It really genuinely helps the channel, and you get a lot more out of this as well. The next company we're going to look at today is Lululemon, and it's another company that I know some of the brothers in the community have been buying lately. 78% upside from where we are, $20.5 billion market cap. No dividends to speak of. Profit margin of 16%, return on equity 42%, return on invested capital 30%. So very well run business. Is one of the most premium athletic brands in the world. We know it has a strong brand loyalty when it comes to that side of things, higher margins and growing international presence. But right now they can't get, those two are very similar in terms of the markets that they're in. Those retail companies are very much struggling because what's happening is they get their products made in somewhere far away from the US, and the US is now fighting with everybody. So in order to make those products, to ship it into the UK, to the US, they will have to pay all these tariffs, and that's what the basically is hitting their margins, and people are a little bit skeptical. But I genuinely believe this is the time to buy this type of businesses when they're down, and when people are saying whatever. Donald Trump is going to leave soon. The tariff situation might change. If another basically president takes over, for the next 3 years they might suffer. But then once he's gone, I'm sure whoever takes over will be a little bit more different to the approach. They might have a different approach. You never know. I'm just sort of speculating. But the EPS right now is expected to be about 1%, which is nothing to speak of. Revenue is about 5%. But the fact that it's 78% undervalued at this point in time is ridiculous. So looking at fast graph, as you can see over the last whatever years, it's been okay, just above that line, orange line here and there. And then it got up, and then it basically 2020, so COVID happened. Since then, it's been going up and down, up and down. Very, very cyclical business. Look where we are right now. Look at that. And if we look at the performance over the last whatever years, so since 2007 up until now, 14% against that 9% of the S&P 500, which is nice to see. Forecast moving forward, so like I said, the earnings expectation for 2027 is negative, 2026 is negative, according to this. By the way, why is that the case? Let me have a look at Lulu, because I used this earnings expectations. Let me see. So is it 11% in 2026, January 2026, which is basically, there's no point using that because that's around the corner. And January 2027, they're expecting about 1%. That's where the 1% came from, and that's where I got the revenue side of things as well. So that's interesting, the fact that they've got negative. But either way, it seems if you bought this stock right now using that, you'll lose a little bit. You will lose a little bit of money. But if you use the normal multiple, which is that 39, which is, I genuinely think is too expensive. But even if you go to 19 PE right now, and I think it's right now about blended PE of 12. So even if you say it's going to go to 19, then you will still be making about 6,000 on top of your money. But if you believe that's going to go back to where it used to be, which is about that 38 PE, then of course you will have 32,000 US dollars after you invested just 10,000 US dollars, which is interesting. And the final company we're going to talk about today is Old Dominion Freight Line. This is one of the best, most efficient freight and logistics companies in America, and they are sort of a part of the less than truckload segment. So this is it's the same thing that's affecting companies like UPS, UNP, or Union Pacific, and so on, is affecting these companies. When the overall market is doing really well, when there is goods to be moved around, when the economy is doing really well, these companies tend to do well. It's because everyone is buying things. These companies that transport these goods back and forth, and for that reason, when the market has come back and everyone is right now everyone is skeptical, trying to hold on to their pennies, but in the next few years, things can easily change. So this company has a 29 billion market cap. Right now, the price is 130. Let's call it 140. They do have some dividends, which is quite nice. 80% safety, profit margin about 19%, return on equity of 25%, return on investable 24%, free cash flow 780 million, and EPS growth expected to be 9%. Revenue is about 4%, which is quite decent. 7% upside from where we are. And looking at fast graph, the company was doing really well. The price was slightly higher than that earnings line. It was in between that blue line and orange line, and then something happened in 2019. 2020 came around. It went to the moon and it came back down again. Ever since, it's been sort of a very, very cyclical. As you can see, it still seems very much overvalued. It has a blended PE of 28, and a normal PE has been about 23 for this company. And that line is that 17 fair value ratio of 17. Now, performance over the last whatever years against the S&P 500. So since 2004, it has beaten almost 20%, and the S&P 500 about 19. So it's basically has beaten the S&P 500, which is quite nice. They're growing that dividend really nicely, which is quite good. And then if we look at the forecast moving forward, now as you can see here, we've got that 8%, 12% expected in terms of revenue growth side of things. If you bought the stock right now based on that, you will be losing that bit of money. If they're using that normal multiple and you bought the stock right now and you expected the PE to hit about that 31, then you will be making about 3,500 on top of the 10,000 that you've invested, which is quite interesting as well. All of these companies are really genuinely great companies, but you just need to buy them right time, and I think some of them it is definitely the right time into it. And these two are my favorites, I'll be honest with you. These two I'm a little bit skeptical. Deckers Outdoor, I had it in the family portfolio. I actually sold it with a little bit of profit a few months ago, but they are all great companies. I never owned this one. I don't think I would ever own this one. I looked into it a while ago. I've already got companies similar to that in the sort of industry, so I don't want to have too many industrials in this portfolio. But I really like these two. These two are my favorites. We'll continue. If I were to buy one right now, it'll probably be this one here and this one here, because this one I'm slightly a little bit up when it comes to portfolio. ADP is the only one I have in this portfolio, so I'll show you exactly where I am with that one. So my average is $233 per share, about 3% up from where we are. 25 shares of that company. So that's the only one that I own right now. And of course, as you can see here, I've just bought basically small portion of into it. I'll be doing like a little bit more research into this, not research, but research and sharing with the community. but I bought this one as well just yesterday, just a small share. So I'm going to continue dollar cost averaging into it. So I'm not just sharing with you guys and just saying this is what I'm doing, this is what you should be doing. I'm telling you exactly, I'm doing basically what I said. I'm what I'm telling you not to do, but I'm sharing my journey. Let's put it this way, okay? I do own this one. Deckers, I've actually sold it a while ago with a little bit of profit. It has come down quite a bit. I'm interested in it. Potentially might look into it, add into the family portfolio again. So we'll see. I'll let you know when that happens, inshallah. Anyway, I'm going to stop the video here. I hope you enjoying this content. If you are, please join us at the Patreon account where you get access to a lot of things. Have a wonderful day. Assalamu Alaikum.